Simon here from findtheedge.com. If you run a business, then you've probably at some point needed to borrow some money. And over the last 5 years or so, banks have seemed to have slammed the door shut in business owners' faces. Well, today we've got someone very special on the show. Someone who is challenging the old banking model and totally revolutionising the way they lend money, and has created his own crowdfunding platform called Bank to the Future. So today it gives me great pleasure to welcome Simon Dixon on the show. How are you, Simon?
Very well, Kenny. Very pleased to be here. Thanks for having me.
So what exactly is Bank to the Future and how does it work?
Okay, well, Bank to the Future does two things. It allows anybody to be an investor and invest in private businesses. A game that was previously only really done by very wealthy, rich people, by venture capitalists, and really by banks lending companies money. But what we've done at Bank to the Future is we've created a platform whereby anybody can be a bank, anybody can be an investor, and they can start from as little as £10 and support the businesses that they like. On the other side, on the flip side, it's a new way, a new process for businesses to raise finance. Essentially, we've taken the processes that our team and myself used to use to raise billions for large companies, and just stripped out all the costs, all the restrictive upfront fees, and made it accessible to smaller businesses who need to raise smaller sums. So
what is your background then, and how did you come about this idea?
Well, I've indirectly been involved in banking and finance my whole life. I'm an ex-investment banker who left in order to become a bank lobbyist. But my first introduction to banking was when I was trying to get a job at an investment bank and got rejected from I've got all the rejection letters still, 96 of them I got rejected from.
Wow.
And I was told that I wasn't educated enough, so I went and did a master's in economics and then got rejected from 125 of them. So I started as a tea boy, knocked on the door of a company called TD Waterhouse, and got myself a job as a tea boy. A month later I was a stockbroker. 6 months later I was a trader on the trading floor. 2 years after that I was working with large companies, helping them take their companies public, and at that moment I really fell in love with entrepreneurs, and when I met these companies that started from their bedroom and were now floating on a stock market, I was just fascinated by their story. So at that moment I quit my job and went on my own journey. It was about 7 years ago now, to the trials and tribulations involved in setting up a business. My first business was a training company for investment bankers, and it was a real culture shock going from the large investment bank where you've got all the support around you to you are the support, you are the technical support. It's a problem, you're doing everything yourself.
You have to order the staples, they don't just arrive.
Absolutely, yeah. So it was a bit of a shock, but after about a year of doing that, the chaos turned into a bit of a business. And then I managed to secure some angel funding from a wealthy investor. His name was Peter Hargreaves. His net worth was 1.3 billion.
Wow.
And it was interesting to experience the whole process of raising finance for your own business rather than for clients at that time.
Yeah, and did you find it quite different, the process?
It's very different, because I was used to taking a business that's doing well, that's established, that's making money, and pitching that to what we call institutional investors. So institutional investors are like venture capitalists and pension funds, and what they do is they essentially pull together billions and billions of pounds of other people's money that we all contribute to, and they invest it on behalf of their fund.
They're like the market movers, aren't they?
Absolutely, yeah, and they control vast sums of money, and it's a very different game. Whereas when you start your own business, really there's not much more to pitch other than the belief that the investor might have in the team that are going to execute the business.
Yeah.
So your job is really to pitch And it's a trust game as well. But the major difference is that institutional investors, you're not going to find a pension fund that wants to invest in a business like ours. You have to go out and find wealthy people, or you used to have to go out and find wealthy people. The difference being is that when they spend their own money, they're spending it a little bit differently to when they're spending somebody else's money.
Yeah.
So it's a different game.
And did you need to raise finance to get Bank to the Future off the ground?
Yeah. So we when we left that business, and my next business was Bank to the Future. And we went through the same process. So I reinvested all my money that we had from the last business, and built the foundation of the team and the technology. But surely enough, we ran out of as much cash as I could put in personally. So we needed to go out and pitch investors again. So I did the same process, and we managed to get a group of high net worth investors that were willing to invest. We did all the deal. We paid the legal bills, and for some reason, about 3 months after, we still didn't have a deal. The money wasn't in the bank. 4 months later, the money wasn't in the bank. And every time we were just about to sign the deal, there was always a reason why we shouldn't sign. It might be that one of the investors was in Dubai or something. So what the problem was is that we'd already promised a launch date for Bank to the Future on social media, and we've got quite a large following. So we didn't want to let anybody down. So I was stretching our finances as far as we could possibly go.
Yeah.
And then the final day came along where the investors said, great, right, now we're ready to go ahead. There's only one thing. We want twice as much equity. I think it was 1/3 as much equity, and they want to pay half the amount for it.
Wow.
So what actually happened was something that I would normally advise other people against, and it happens all the time. It's a very common story, but it actually happened to us as well. And that is that they were waiting for the moment when we really needed the money, and then trying to get the best terms they could possibly get and squeeze it a little bit further.
So short term though, isn't it, as well, because that sets the scene for that relationship going forwards. And it happens so often. It's happened to me actually in the past. What did you do at that point?
Well, obviously we were put in a situation, but when you've been strung along for so long, it's almost a bit of a relief. Because you can then make your next move. But when someone's stringing you along for so long, you're kind of not sure whether you need to move on or what.
Yeah.
So initially it was a relief, and it was also definitely, with hindsight, the best thing that could have happened, because taking on investors, it means that you're going to be working with these people, especially if they're investing a larger sum. So it was good to know the ethics of the investors at that point.
Yeah.
So anyway, what we did is we, by hook or by crook, we figured out a way of launching Bank to the Future. We called in lots of favors, and we managed to launch it. And what we did is we got the platform in a state where we could raise our own funds on our own platform. We launched a private pitch, and we put it on the platform, and we raised more than the funds that we were actually going to be raising from the high net worths, which was such a really amazing experience, and it really fueled the team to get this product and get this platform out there, because we actually were a consumer of our own product.
Yeah, it reassured you that the product is going to work.
Well, yeah, and for us, it completely changed the game, because we raised funds from lots of smaller investors. But the interesting part was most of them were other entrepreneurs rather than people that really classify themselves as investors.
Right.
So we created a real amazing environment of other entrepreneurs funding us. And the difference between entrepreneurs and investors, and I'm not saying that investors don't have their role, because they totally do. But other entrepreneurs have shared the journey. They know how hard setting up a business can be. They know the challenges.
Yeah.
But also, if they've got to the point where they can start making some investments, then they've also shared a bit of success. And in building a business, you build lots of contacts along the journey. So having lots of investors that all invested smaller sums, that all have lots of contacts, that also understand the challenges and journey of entrepreneurship. Has been really, really valuable in getting the brand out there.
I bet it has, and it's kind of created a whole new subset of investors as well, hasn't it?
Well, that's the point of Bank to the Future and what we call crowdfunding. Is one of the very important things to us was not that we created a platform whereby internet savvy angel investors could invest online from home. While they can do that, and we're completely open and accepting, and we have a new way for people to do that. But the really important part was, and our mission really in the company, was the democratization of the investment decision.
Yeah. So
we wanted it so that anybody could invest. If you had a tenner, if you had 100 quid, if you had 1,000, if you have 100 grand, there's investments that you can make. And really the most important part is that it brings in a new source of finance, because at the moment, the reason that this story is so frequent with angel investors creating terms, the battle with the entrepreneur, and not all angel investors are bad, but it happens very frequently. The reason being is because there's not enough angel investors for the amount of businesses that need funding. And I don't mean every business should get funding, because there's lots of crazy ideas out there that haven't really been through the rigor of being able to execute on the business.
Yeah, but you're saying it's an investor's marketplace.
Correct. It's an investor's marketplace at the moment. So what we want to do is make that a little bit fairer. And the only way we know how to do that is lower the barriers to who can be an investor, whereby there's lots more investors, and then a fair decision can be made based upon more investors being able to invest.
Yeah, fantastic. How does it differ from the likes of Kickstarter, which started up in America, didn't it?
Well, Kickstarter is a fantastic company that solved a very big problem, and the problem that they solved was creative projects that need funding, that aren't necessarily the type of business where they've got a very rigorous business plan. They really just want to bring something to market, bring a new product to market, and what they allow people to do is offer rewards to anybody that would like to donate. So the classic example with Kickstarter is they had a company called Pebbles Watch, and Pebbles was turned down by a lot of venture capitalists. They wanted to create this new watch. I'm probably doing a bad pitch and the company would kill me for it, but essentially it speaks to your iPhone and your Android device.
Yeah.
And what they did is they went, look, here's the watch, here's the prototype, here's what we're creating. If anyone would like one, in 9 months' time, we'll be able to deliver it if we can raise 100 grand.
Yeah.
And they said, contribute $150 and you can have one of the watches in 9 months' time. I think they had, and on record, I'm not sure if this is the right numbers, but you get the point. I think they had about 67,000 orders and raised 10.3 million.
Wow.
And that's an extreme case study. The average pitch on Kickstarter is around about $10,000 or so.
Yeah.
But where we differ is we have taken that very same exact concept called crowdfunding and created a product called crowd investing and crowd lending. And what they do is exactly the same. You can still offer rewards to people that want to donate, but you also have an investment pitch where people, so in order to scale the amount that you can actually raise, you need to sometimes incentivize people beyond just rewards.
Yeah.
And it's not right for every business. If you've got a business that's not, you can't put a business that's quite boring on Kickstarter because the rewards just don't get people going. But what we've done is we've made it so that people can invest and buy shares in the company, or if they're creditworthy, they can lend money to the company as well. So it's like Kickstarter with returns just for businesses rather than creative projects.
Which is great, because I remember going on Kickstarter and I actually thought that's what Kickstarter was about when I went on it, when it first came around. I thought, great, I can invest in these companies, and in actual fact you can only get rewards, can't you, on there?
Correct, yeah. So investing is a very regulated activity, and Kickstarter, they've built this lovely community and they're doing extremely well around raise funds but don't give away the equity, which is great if you can do that, but not many businesses are in that kind of position where loads of people are willing to give them and donate the money.
Yeah, exactly. I mean, especially in these recessionary times, how do you find that ordinary people, the crowd as it were, are they happy to invest in these bad times with, where they're investing in unknown businesses with fairly unknown owners?
Sure. So, there's no doubt, and we're very, very clear on our website. Before you make an investment, we'll let you know what investing in a private company means. It's high risk, high return.
Yeah.
And, if you're investing in equity in business, there's the way that the game works is you tend to invest in about 10 companies, and it's long-term investment, and you're looking for one of those companies to become what might be the next Facebook,
yeah,
or what might be just a very, a smaller viable business.
Mm-hmm.
And one day they'll get sold, and there's a big market for purchasing businesses. That's how you get your returns.
Yeah.
That's with the equity side. With lending, it's less risky, and it's really because it's only mature businesses we accept to be able to borrow.
Yeah.
But what we found, don't get caught up in the negativity of the economy. All we're in is a shifting economy. In the case of the UK at the moment, over the last 8 years, the money supply has literally doubled. So there's more money out there than there has ever been. It's just simply not making its way to the right place. The reason that is because most money is invested or redistributed through a bank, and banks don't tend to invest in business. They'd much rather make loans for property, or, as we've seen in the case of the crisis, financial speculation.
Yeah.
Whereas a tiny, tiny percentage of it, which is why if any business goes to the bank right now, and they ask for a loan if they're creditworthy to borrow and buy a car, they'll probably get yes if they're creditworthy. If they said, well, I'd like to borrow the same amount of money and do a business, they'll say no.
Right.
Because they don't like lending to business. So we're in a shifting time where people want to see what's happening with their money. There's record levels of skepticism with traditional finance and banking. There's double the amount of money in the economy, and most of the traditional products that people have invested in aren't working the way that they used to work. So people, and we're in an environment of transparency because we're in the social world now where everyone has a voice.
Yeah.
So it's just a shift rather than there is no money.
Yeah, well, you've just reassured me that there's definitely money in the economy there. What kind of tax benefits are available for investors, and can you help them tap into these?
Yeah, well, the government are really, really supportive of people investing in businesses, and consequently they've given some very generous tax breaks. I can only talk from the perspective of UK investors or UK people investing in UK companies. Mm-hmm. But there's one particular scheme which is the most generous thing that our government has ever given, and it's called Seed Enterprise Investment Scheme. And on our website, we have on every pitch that qualifies for this scheme, there's a little SEIS green badge where it pulls up a video explaining how it works.
Yep.
But essentially, in a nutshell, and I have to put all the disclaimers out that I'm not a tax advisor and this might change. But essentially, if you invest in a SEIS qualifying company, you can get 50% of your investment claim back from the income tax that you've paid. So if you're an employee and you pay income tax,
yeah,
or you're paying yourself in your business income tax from your wage,
yeah,
is one of the only ways that you can claim back your income tax. There's hardly any ways of doing that. And it's very generous, but also if you've just sold a property or a business and you've made a capital gains and you've paid some capital gains tax, you can reinvest that in the business, and HMRC will allow you to reinvest it so you don't pay the tax. And also, when the company sells, or if the company sells, I should say, is capital gains tax free. And if the company does go bust, in the unfortunate event that happens, which unfortunately it happens more frequently with this type of risk profile of business, but you can offset some of the loss against any tax that you paid.
That's amazing. So that is really, really, really good and really, really enterprising. And what qualifies one of your investments to have this attached to it, and how many of your investments do have this attached?
Okay, so from our side, almost all of the crowd investments qualify for SEIS. It's a particular area that we specialize in.
Yeah.
And all you need to do is look for the badge, and you can see that.
Yeah.
But what we do is, when a business wants to pitch on our platform, we put them through a rigorous 4-week process of making sure that they qualify for the right tax. They set up their company in the legal way that's correct for investors and correct for them. They go through their business plan, they go through their financial model, they record their video pitches. We help them through that process.
Yeah.
And then once they list on the platform, if they wear the SEIS badge, then we've been through the process of helping them apply in the correct way.
Yeah.
And also the HMRC will send them a letter confirming that if they continue to hit the rules, then they will still qualify. Now, there's certain rules and caveats, and the video explains that.
Yeah.
So you can't give a full guarantee, but as long as they continue with the rules, then you can claim back your money.
Brilliant. And you just mentioned, and you brushed on the fact that you help entrepreneurs. How does this work? You know, if I'm an entrepreneur and I've got an idea, I need 150 grand, I come to you, but I've never had any investment experience in the past. What can you do for me?
Okay, so we feel our particular position as a platform, and this is just, you know, our opinion and how we run our business, is that we feel we have a duty to filter all of the businesses wanting to raise finance for a couple of things. The first thing we filter for is quite obvious, but it's fraud. So we implement a lot of the same processes a bank might go through to check that you are who you say you are, and you're the right type of person to be pitching investors.
Yeah.
We also update traditional scoring with data from social media. So we want to make sure that you're the right type of person, and we ask people to connect their LinkedIn, their Twitter, their Facebook. We just want to make sure you are who you say you are. We're not making an opinion on whether we like you or anything, or whether you're fundable or anything like that. We just think it's important for transparency today.
Yeah.
The second thing that we will then filter for is we will filter for whether you're willing to go through our process to get investment ready. And what that means is that we feel that, you know, raising finance shouldn't necessarily be easy, because you still need to make sure that your business plan is right, you're viable, all that type of stuff.
Yeah.
And so in order to assist people with that process, we've created, for people that aren't in London, offline incubators. Mm-hmm. For people that are in London, they can come and join us through, sorry, I think I said the wrong way around, who aren't in London, online incubators. For people here, offline incubators. But you may already be completely investment ready, and if that's the case, then we can just put you straight on the platform. If not, we've got support, and we can help you with that process. The thing that we're not filtering for is we're not filtering for whether we think you've got a good idea or not. We don't think that that's our job. That's what banks do. That's what venture capitalists do. That's what rich angels do. But if we are not filtering for whether we think you've got a good idea, the crowd determine whether you've got a good idea by whether they invest or not.
The market tells you.
Correct.
What's the minimum an entrepreneur can look to raise, and is there a maximum?
So our official minimum is round about 5 grand or so. However, in order to go through kind of a bit of the rigor and process, we think that raising a minimum of about 30 grand is probably a good place to look for. Now, at the moment, there is no maximum. However, there's some norms. It's important to understand that the way crowdfunding works is the more people you can reach, the more you can raise. So if you have a very large following and you've been behaving yourself online, and you've got a good offline contacts, and you can, you know, meet lots of people, then the limit is really endless.
Yeah.
But if you haven't got a good following, then there are some limitations because crowdfunding really depends upon how many people you can reach. You've got to have a crowd to make it work. And it's important to know that even, with Kickstarter, with everything, it's not a place to build a following and build a crowd. It's a place to essentially monetize in a compliant way an existing following and an existing crowd.
Yeah, yeah.
Which is an important part.
I think obviously it does help your platform. All of these different crowds coming to your platform, it must grow your following. So there must be some benefit where they do actually get investment from people that are not attached to their crowd. What percentage would you say that is?
Sure. So we've seen some sweet spots. So obviously we engage in all our own marketing activities and make sure we have a community of people that are into this. But the spots that we've found is that the people that don't raise their funds, they tend to sit there at 0% and never move.
Yeah.
There's two rules that come into play, and this is both traditional investing and crowdfunding. The two rules, if anyone's ever read a book, I think it's Cialdini's Laws of Influence. Two of the laws of influence are the rule of scarcity and social proof. And social proof has never been more apparent when it comes to crowdfunding. Strangers like to look at pictures that are already moving, that are exciting, and that every time they log in, there's more being raised.
Yeah.
It provides this, the social proof that's needed to give a stranger the comfort that this business is exciting to others, and also that the entrepreneur can actually market, because that's going to be a huge part of whether they succeed as a business.
Yeah, plus it's that human need. I hate to say it, but we can be like sheep, and if you look at eBay, for example, that's why eBay is so successful. It's the scarcity model, isn't it? Once you see it's coming to the end and there's lots of bids on something, you kind of want to bid yourself.
Yeah, and the scarcity comes straight into crowdfunding as well, which is why if you reach a certain point, a lot of it happens in the final hours. So your job when running a campaign is to try and get through the dip and try and get it so it doesn't all happen in the final hours, because it couldn't give you a heart attack. Because it's all or nothing. Remember here as well. You have to hit either your minimum funding goal or your total goal. Otherwise, you give all the funds back.
Yeah, which I think is a great rule, because they can't really get going without the full funds anyway. Just on a slightly different note, I've obviously we've bumped into each other before. We've seen each other in America at conferences. I think you're at a conference I was speaking at once. Do you think all of that experience in the digital marketing world that you've gleaned has helped you create mini launches here? Because that's what you're doing, really, aren't you? You're helping launch a fund for these businesses.
Well, certainly, and what I'm really excited about, because crowdfunding, it's still early. We're nowhere near raised as much funds as the banks and traditional institutions.
Yeah.
But that's only a question of time. I really believe this is going to be a mainstream product that's going to change the world, in fact. But what's going to start getting really interesting is when people really start applying best practices of marketing and launch formulas to their crowdfund. So, the traditional product launch formula where people are creating content and then the final video might be their sales pitch.
Yeah.
It's going to be really interesting when we start seeing people create 4-part video series, and then the final is you can actually invest in the company. It's going to be really interesting as that evolves. It's too early. I haven't seen many case studies of that, but everything that applies to traditional marketing will also apply to your success in your crowdfund.
Do you think you'll kind of start helping them with these launch formulas, kind of Jeff Walker launch formulas?
It's going to be really, really interesting to see where that goes. If I'm honest, I'd rather partner with people that can help us facilitate that process. So
yeah.
What you're going to see is if you're asking me to make some forecasts, you're about to see an amazingly large untapped industry emerge right now, which will be the whole sector of assisting people in crowdfunding, assisting people in marketing their crowdfunds, And when you know you've got a very large sector that's about to emerge, is when other people start building businesses around your business.
Yeah,
And
absolutely.
that's when you know you've got something. And we're starting to see that now, where people are setting up businesses just to help people, get through the process of raising finance on Bank to the Future.
Yeah, that makes sense. We're running low on time here, so we're going to have to say that's the end of part 1, and we'll see you again on part 2. From Simon Dixon from Bank to the Future and Kenny Goodman signing off from findtheedge.com. See you in part 2.